Welcome to Westminster College's Center for Financial Wellness. This course is going to be on the Introduction to Financial Statements. All right, first of all, let's just talk about what the purpose of financial statements are, because they're costly to make for companies. So why would they bother expending the time, the money, and the effort to create them? Well, financial statements are what companies use to communicate the results of that company's operations to those that are external to the company, like banks or investors or analysts. Since these external people don't have access to the amount or the type of information that owners or management do, then these external users have to rely on the companies to provide that information, and they do it via financial statements. Okay, often external users will analyze the financial statement information and compare it to prior years for that company, or even compare it to other companies. And in order to do that, these comparisons, in order for the comparisons to make sense, then the companies have to create financial statements that are consistent, both from year to year and from company to company. In other words, all companies follow the same accounting rules to create their financial statements. All right, so the four main financial statements are the balance sheet, the income statement, the statement of stockholders' equity, and the cash flow statement. Okay, while all of these financial statements, well, each of them focus on a specific types of information or different aspects of what the company has been doing, they all are based on the exact same transactions. They just view it from a different perspective. We'll take a few minutes now to look at each of these financial statements and see what each is about, how they're each unique. Okay, the first one we'll start with is the balance sheet. The balance sheet summarizes the stuff, as I've said, that the company owns or controls, as well as displays who has claims to that stuff. All right, so the stuff that I'm talking about, we refer to it in accounting as assets. So assets are things like buildings, a truck, inventory, cash. Those would be assets. Right, these assets for a company will have claims on them, either by the company itself or by an external entity, external to our company. So claims that a company has on its assets are called equity, and claims that others that are external to the company have on the assets are called liabilities. In other words, companies don't necessarily own all the assets that they have listed on a balance sheet. Some may be owned, but some the company just has rights to use. Likewise, a single asset could be partially owned by the company, equity, and partially owned by a creditor. So that would be a liability. If you have a mortgage on a house, you're very familiar with this concept. So let's explore it a little bit more by looking at a purchase of a car. All right, so let's pretend that somebody buys a car. In our little example, they're going to spend $30,000 on it. Here's our $30,000. And he buys it by getting $10,000 of his own cash. He saved it up, earned it, whatever, and then he gets a loan from the bank for the $20,000. All right. So the individual who bought the car then now has an asset worth $30,000 with equity claims of the 10 and liability claims of the 20. So that gives us what we call the balance sheet equation. So assets of 30 equal liabilities of 20 and equity of 10. This is a really important, it's an incredibly useful equation for accountants and analysts. And we're going to use it later in future lessons to help us analyze individual transactions. But for now, we're just going to note that that is called the accounting equation or the balance sheet equation. And we're going to also note that the balance sheet equation basically is the balance sheet. But the balance sheet is just really nicely formatted, so it's easier to read. So I've got a little example here of a lawn care company, some company who's mowing lawns for the summer to make some cash. So we're just pretending like this is their balance sheet, and it looks like their assets totaling $18,000 include cash of 2, accounts receivable 1, and some equipment, probably lawnmowers, etc., of 15. All right, the claims against the assets of the company are equal to the assets, as we said, and those claims are made up of 6,000 in liability claims, a loan from a bank, and then 12,000 equity claims. So the company owns $12,000 worth of those assets. Okay, the balance sheet gets its name from the balance sheet equation because the total assets have to equal the total claims, claims being liabilities and equity. All right, so just wanted to provide a little snapshot of an actual balance sheet. This is from Under Armour from 2020. And you'll notice on here, here's their amount of assets, total assets, the 5.030. This is in billions, wow. And here is, it equals their total claims, so the total liabilities and stockholders' equity. So those total stockholders' equity of 5.00030 is made up of 1.6 in stockholders' equity and 3.3 of liabilities. So there's a lot more detail, but you can see how this is basically the balance sheet equation. And on this balance sheet, we can see even more detail. We can see they have some cash, accounts receivable, inventories, some prepaids, some property and equipment again. They have some items that they have a right to use from a lease, goodwill, and some intangibles. This is important. It shows us the types of assets they're using in their company to run the company. Okay, and likewise in their liabilities, we just have some more insight in the type of liabilities they have, accounts payable, some long-term debt, some lease debt. Down here in their stockholders' equity, we see that they have 3 different classes of types of common stocks. So this is owners buying into the dream of Under Armour. So that is a more complete, detailed balance sheet. Okay, our next financial statement that we're going to look at is the income statement. It's also called the statement of operations. And it provides a view into the value of the activities that the company participates in. Okay, the elements that will be on the income statement are going to be revenue. And when I say revenue, it's revenue and gains. They're kind of the same thing, but I'm just going to generically use revenue. So revenue and expenses. And again, with expenses, there's another type of expense called a loss. So there's actually 4 elements: revenues and gains, and then expenses and losses. And I'm just going to generically say revenues and expenses for now. All right, the relationship of those is that revenues minus expenses are going to give us our net income. This is the financial statement that tells me how profitable a company is. Their bottom line, you'll hear that sometimes. All right, so here's a little example of an income statement. Let's pretend like we have a friend, Joey, who finally got a part-time job. He's working at a convenience store and he earns wages for the month of $400. But in order to get to the job, he's got to pay bus fare of $100, and then he's also assessed some taxes of $80. So given that information from an income statement perspective, this is what his income statement for the month would look like. He's earned $400, but he's had to, so that's the value of the activities he's participated in, all right? And that generated wealth. The expenses he also had to participate in. He had to pay the bus fare. He has to pay his taxes. But those are wealth using activities. So our revenues minus our expenses will give us our net income of $220. So he's $220 better off at the end of the month for having participated in those activities. All right, again, another little example from our lawn care company. Let's just kind of look at it and see if we can figure out what they've been doing. So they've been participating in wealth generating activities for $25,000 for the year. That's how much they've earned. The activities they've had to participate in that used up some of their wealth are going to be salary, had to pay people, had to use up some gas, some advertising, and had to pay taxes. All right, so those equal 20. So this little company's net income for the year is $5,000. So again, this is a simple revenues and gains minus expenses and losses equal our net income. Again, I just wanted to provide an example of an actual income statement, or they actually call theirs the statement of operations, like I mentioned they might. All right, pretty standard. Here's our net revenues. So this is them generating wealth by selling athletic apparel and equipment. Here's the cost of the items that they sold. So they have what we call a gross profit of 2.1 probably billion. All right, here's some of their expenses. Some more of their expenses. The general administrative and selling expenses are going to be the things where they rent expense, salary expense, utilities expense, everything is just bundled into one big number there. Looks like they've had some restructuring they've had to do, so that's been an expense in 2020 and 2018. Let's see what else. Some interest expense, probably have some debt, so they got to pay some interest. And there's tax expense, we would expect that. But bottom line, here is their net income. Looks like in 2020, they incurred a loss, bad year for Under Armour. But bottom line, their revenues minus all these different expenses give us their net income. So they're not better off in 2020. From their activities were worse off. They weren't able to generate net income. They had a net loss. Okay, cash flow is our next financial statement. Because cash flow is has such an important role, it gets its own financial statement. So the purpose of the cash flow statement is to provide insight as to how the activities that the company has been involved in generate and use up cash. On the cash flow statement, each activity that involves cash has to be included in one of three areas. And I've listed these here. The operating activities, investing activities, and financing activities. We'll learn a little more about what those mean, but just briefly, operating is exactly like it sounds. It's me running my business. It's our lawn care company mowing lawns. Investing activities is going to be our companies buying long-term assets, something that lasts more than a year, or possibly buying investments. If they have some extra cash sitting around, they could buy some investments to utilize some of their cash. Financing activities, I like to call these activities where you're begging for money or paying back people who you begged money from. So it's going to be from borrowings from creditors or contributions or dividends to stockholders, ownership. So cash flow has that unique perspective of the activities. All right, we've got a little example here again. All right, so we're going to say that Barry, we're going to look at Barry doing some activities, and we're going to look at it from a cash flow perspective. So it's important to realize that we could look at the same scenario from Barry from the income statement or the balance sheet, but we're looking at these activities from the cash flow. Okay, so Barry wants to buy a bike that costs $500. So he works for a month and he makes $300. So he has his own money. He receives a loan from his mom of $50, and then his brother Larry agrees to give him $150, and in return, Larry gets to use the bike. So you can see that Larry has a little bit of ownership, whereas Barry's mother does not. This is just a straight up loan. She expects to get paid back. And so how would we interpret this on a cash flow? All right, so cash from operations, that's from Barry working, that's going to be our $300. And notice it's positive because it's an inflow. He's getting that money. He's the company. Cash from financing, we're going to go down to that one next. It's 200, and that is made up of the loan from his mother of 50 and the inflow of cash from his brother, Larry, of 150. That's the 200. So Barry gets another $200. What does he do with the 300 and the 200? He spends it all investing in a bike that's going to last longer than a year. So this is a simple little example of what a cash flow might look like. His net cash flow for this period of time is 0. He used up everything he earned and borrowed or begged his brother for. All right, here's our example. Another example. So it's our little lawn care company again. This one has a little more detail. Let's see, for the year ended 2022, they had operating cash flow, net cash flow of $4,000. So them mowing lawns got them $4,000 inflow of cash. So it looks like they took some money of their earnings, their money, and invested in some assets, maybe more lawnmowers, but it's an outflow. You can see that it's $10,000 outflow. And then again, from financing activities, whether it be from a loan from the bank or somebody contributed more ownership capital into the company, they had an inflow of 1,000. So if you add these three up, the 10, negative 10, and the 4 and the 5, so negative 10 plus 5 is negative 5. So that explains the cash change for the period. At the very end of the cash flow statement, what you're going to see is what we started with. We started the year with 7,000. We ended up with 2. Well, that would mean that we used up 5,000. So that's what this is telling us. We went down by 5. The main part of the cash flow is explaining how we decreased in this year by the 5,000. So that is the perspective of the cash flow and what it does for us. Again, showing you an official financial statement from Under Armour. It's a busy financial statement, but let's just look at the basics. Here is our cash flow from operating. Here is our cash flow from investing. Here's our cash flow from financing. So the 3 basic areas that we have. All right, here's our net cash increase or decrease. Then this shows us what we had at the beginning. So we had 796. We had the 732, and we now at the end of the year have about 1.5 billion, I guess this would be, in cash for Under Armour. Yes, so there is a lot of detail on this beyond our class. But you can look at some of these and see it kind of makes sense. In investing activities, they're purchasing a business, they're selling a portion of a business, MyFitnessPal. They're buying some more property. Down here in financing, it's dealing with debt and some stock options. So these kind of make sense. These are things that I would expect to see in here. The operating activities is a little harder to understand, but again, it's going to be the activities that generated cash from operations. So from Under Armour selling their athletic apparel. Okay, our 4th financial statement, Statement of Stockholders Equity. This one provides details about changes in the ownership claims of the company. Those who have ownership within a company are really interested to see how the activities they've participated in have impacted the ownership rights. Okay, remember that equity is one of the elements on the balance sheet too. Remember, assets equal liabilities plus equity. The balance sheet just shows the balances as of a specific day. The statement of stockholders' equity is going to show us how we got to those balances. It'll show a beginning balance, what the changes were, and an ending balance. So it provides more detail for the owners to understand changes in ownership equity. All right, so here's our little lawn care company example. Very simple one. We have a company, December 31, 2022. Shows that their beginning equity was 12. They had some activities. These 3 items right here are the activities that happened during the year to get from 12,000 to 16,500. This company generated income, net income, that came from our income statement of 5,000. So the owners contributed, bought more stock or whatever of 500, and then they paid dividends out to the owners of 1,000. So the net increase of those activities brought us up to the 16,500 for their ending equity balance. All right. Okay, it's really important to remember that these financial statements are all summarizing the same business activity results. Each is simply looking at the results of these activities from a different perspective. The income statement explains results of operations of the business, what activities generated wealth and what activities consumed wealth. The balance sheet communicates how those activities have resulted in company assets and claims, both equity and liability. The cash flow summarizes how those activities impact cash flows, inflows and outflows, in operating activities, investing activities, and financing activities. Then finally, the statement of stockholders' equity indicates how those activities have impacted our ownership claims. The financial statements relate to each other. They are not isolated. They relate. And I'm going to show the next slide to kind of explain the relationship of the financial statements. All right, so we're going to pretend like this is a timeline right here. Go from one year to the next. So as of December 31st, 2022, we're going to take a picture of our little company. That's literally what a balance sheet is. It's like taking a picture on a specific date of what the company looks like, what their assets are, and what their claims are. All right, so time passes. And as of December 31st, 2023, I take another picture of my company. And I look at what the assets are, what the claims are, the liabilities and the equity. These two balance sheets are going to be different. And everybody's going to want to know, how did they get from one balance sheet to the next? Well, the financial statements that explain the changes are the income statement, the cash flow, and the stockholders' equity. Each one explains the changes from a different perspective, as we've already talked about. But I provided this so you could just see how the financial statements actually are very tied together. All right, and the next slide is going to show it even more in detail. So this is the same thing. I've got a balance sheet right here. I've got a statement of cash flows, income statement, statement of stockholders' equity, and then I've got a second balance sheet. So we can see the same relationship as I saw on the previous slide. This particular slide, however, provides some more information. It helps us see that there is specific data that is shared between financial statements. I'm just going to show you a few. So here's our income statement. Here's my net income. You'll see that that net income of 59,000 is also on the statement of stockholders' equity. It's borrowed. Remember, revenues minus expenses equaled our net income on the income statement. In our statement of stockholders' equity, our beginning balance plus our net income, remember that on our last one of our slides, and a couple of the changes equals our ending. So there's our net income that impacts our equity. Okay, similarly, my cash balance, my ending cash balance of $25,000 is going to be the same cash balance that you see on your balance sheet of $25,000. Likewise, the balances or the totals on my stockholders equity financial statement are also going to be seen on my balance sheet. Here's my contributed capital. Here's my retained earnings. And here's what we call other. So they're all shared. So I wanted to show you this because I wanted you to appreciate how closely tied together the financial statements are. They're not isolated. So and as I've said, it's important to understand this concept when you're analyzing. The financial statements are best viewed and analyzed together rather than individually to get a whole picture of how the company's doing. For our purposes in this little class, it's really good for us to understand that these financial statements articulate, because it's going to help us when we start the next lesson using the balance sheet equation. So that is the end of this class, and I look forward to working with you in our upcoming class, the balance sheet equation.